what do you think are the macro or cyclical conditions right now that are favoring or perhaps benefiting active ETFs over, say, passive ETFs?
With active ETFs, they're designed for specific goals, right? And in this case, we're talking about navigating through market uncertainty, right? As Katie just talked about, big week coming up with the Fed decision and the CPI numbers. So it's not surprising that if you're an investor or a financial advisor, that you might be looking to active managers and active ETFs to help you navigate that uncertainty and help you figure out where you still want to be exposed despite the volatility or the further uncertainty to come.
And I think it's interesting how the active bid has evolved, because for a while it seemed like it was the income-based products, the Jeppies of the world, and its various copycats that were taking in all the money. But then you take a look at the new trends in active ETF issuance, and they've been getting more and more concentrated. You've seen a lot of funds launch with fewer than 50 holdings. And I'm curious what trends you're seeing when it comes to both what issuers are looking to launch and also what investors actually want to put their money behind.
I think that's a great point, and certainly what we're seeing at Vident. At Vident, we partner with active managers that want to bring their strategies to market in an ETF wrapper. And I've definitely observed over the last 12 or 18 months or so that active managers are coming to us with very concentrated portfolios, 30, 35, maybe 40 names at the max. They're very, very particular about their strategy and what they're trying to hold. And so I want to believe that investors, and particularly financial advisors that have confidence in these asset managers and these active managers in particular, that they would be comfortable with that type of concentrated exposure.
And I mean, the pushback that you always get is that, okay, maybe when you concentrate your portfolio, you see a pop when times are good, but when times are bad, they're really, really bad, and you lag the benchmark. I mean, you've been in the ETF industry for many, many years. How do those boom and bust cycles typically look when it comes to concentration?
That's a great question, and I think what the beauty of the active ETF wrapper is that it makes it so easy to exit if, as an investor, you're worried that things are going south, right? You can exit, you'll know when you exit, you can exit the time of day that's convenient for you or that seems right to you, and so you can build a portfolio with ETFs that really match the exposure you're trying to get or have the managers that you want exposure to, knowing that as long as there's enough liquidity, you should be able to get out without too much of a hit.
You mentioned managers that you can get exposure to. What does active really mean? How similar is it to a mutual fund where you have a lead portfolio manager and a team of analysts supporting that PM? How does it compare to, say, an active quant fund, which seems like a different animal completely?
That's a great point. So you're right, with traditional active management, we're talking about the quote unquote your stock pickers, right? Your lead PM, your analyst supporting that person. And then of course on the systematic side, it's similar in that it is really, it's following a similar strategy, but at the end of the day, they're not as concerned about what ends up in the portfolio. They just want to know that their system is working. On the other hand, we're actually also seeing the emergence of more closet indexers. So active managers that are starting with an index as their universe and then making changes as they want. And in some cases, those might be rather minimal changes. So think back to last year where you might have wanted to kick out that regional bank name, or the year before when you might want to kick out that Russian equity name. And so what we're finding is that there's different flavors of active. And so active as a term has become a catch-all for very different types of strategies, leading investors to wonder, how active is my active ETF? And I'm wondering that if, as an industry, should we be thinking about maybe a more specific nomenclature to help investors navigate through the activeness of their ETF or lack thereof?
I think that's a really good point, too. And you also think about single stock ETFs. Those are all considered active as well. And I guess if you're buying one of those, that is an active decision, but not active in terms of picking out a traditional portfolio. But I also want to get your thoughts on distribution. This is something that I talk about all the time with you, but it just feels like it's just getting harder and harder. I mean, Emily Greifeld and I have been reporting on Fidelity, for example, in conversations with issuers about potentially charging when it comes to their platform. And from your perspective, of course, where you sit when it comes to helping ETF issuers bring their strategies to the market, how much more difficult has distribution come? And if costs are going up, where can an issuer then cut costs?
Yes, you're right. The distribution challenge only continues to grow, and Fidelity's decision to start charging certain issuers a percentage of their management fee or their revenue, that's a significant one. Now, of course, some people will point to mutual funds and say, well, they've been doing it for so long, but we're talking about higher expense load, trailers, all the things that we were trying to get away from with the ETF wrappers. So you're right. It's just the challenge just keeps continuing. And so at Vident, what we tell our aspiring issuers is make sure you you are keeping your eyes open, you are well aware of the challenges ahead and come with plenty of working capital. What you don't want to be is in a position where you start to take off and then you don't have the money to support your marketing or distribution strategy.
And in terms of how this could evolve, of course, if costs are going up to get on some of the platforms, could we see ETFs become more expensive? Margins are already razor thin as it is.
That's a tough question. It's really between being a rock and a hard place, right? Because one of the trademarks of the ETF is those competitive expense ratios. And so you're right, how much are sponsors, and particularly active managers, going to be able to get away with in terms of increasing that expense ratio to make up for the margin that they might be losing? It's a delicate push and pull. We try our best to support our managers, but ultimately they need to know the market that they're targeting and what that market's willingness to pay is.
I have a final question for you about the daily disclosure of active ETFs, because that was a big concern early on. It would encourage short-termism. It also would perhaps give away someone's secret sauce and inspire copycats. Is that actually happening now that we see active ETFs really out in force? What are some of the unintended benefits of having daily disclosure for active ETFs?
What you described was very much the narrative that I think we were all as an industry focused on. Are active managers going to be okay with daily disclosure? Are they going to be concerned about front running? And on the investor side, do investors really need to be focused on what's in their ETF day to day? But I think what we fail to recognize is that this daily transparency would actually be a benefit to financial advisors. Financial advisors who can have these conversations with their clients and say, here's what you hold, here's how much you hold, here's what you don't hold. And what we're hearing at Vident is that it really has strengthened the relationship with the clients and has allowed the FA the opportunity to better explain the investment decisions that they're making on behalf of the client.